Okay, thank you very much for joining us today. My name is Andrew Talbot, and I've come from Expat Financial Planning through Globally. And today's webinar, which is in a series of them that we do over the last couple of years, is going to be on a typical expat scenario. So we're going to have a young family that we're going to go through some of the planning that we can do for them and the outcomes as a result. If you're doing this through Zoom, the software, then by all means, please ask some questions. If you're doing it live on YouTube, then there's some details that you can get in contact with us at the end. And if it's a recording, then by all means, get in contact whenever you can. We're coming from Singapore, as you can see from the background behind us. And so if we go through to the next stage, what we're trying to do is show you what cash flow forecasting and financial planning can do for this particular couple. So everything that we do as a financial planner will encompass like retirement planning, investments, education, inheritance, mortgages, buying houses, passing on information, passing on assets to the next generation. So it impacts everything. So everything you do today will have an impact on your future. So the implications can be big or huge, depending on how we look at it. When we're doing the forecasting or the financial plan, really what we're trying to do is find out what your assets and liabilities are, income, expenditure, work out what your goals are, like what do you want to do, and we'll show you some of the goals that we think people should think about. They could be retirement, but there are some other things to do. Look at your future self. I.e., where do you want to be in a couple of years' time, or 10 years, or retirement, or in retirement? Try and work out whether or not future investment returns or economic conditions are going to make a big difference to you. And then work out whether these shortfalls or surpluses, some of the big expenditure that you need to do in the future, what's the impact of that? And really, it's all about these what-if strategies. So what if investment returns were less than you expected? What if inflation was higher than you think? What if your income was greater, or you paid down some of those liabilities or mortgages? And that's really what we're trying to explore. And I'll give you a couple of the example we'll go through today. And then it's the financial plan that gets made. So we talked about some of those individual goals. So that these are really sort of cliche: first son, going to university, holiday, changing your employment, or having a second career in retirement. They can all be very different planning opportunities or planning events in the future that you need to take into consideration for. This is a cliche client. Or a cliche expat, Aaron and Sophia, 38 and 36. They've got 2 children, Daniel and Emily. They'll probably go to university and then they're going to retire. Okay, so you got your pre-retirement along here, and then you got retirement, and then you got this slowdown where you're not necessarily going to be living life to the full as you would in your retirement years. So very cliche, very simple. It's quite high level in terms of the planning we'll do. We're going to go into some detail, but it's not going to be a huge amount of detail. First of all, we've got to create these assumptions. So you've got lots of different assumptions that you need to do. So investment return, inflation, wage earnings, what your current portfolio looks like, what risk can you take, what the return is expected on that portfolio, what your property increase is going to be, where you're going to be, what's the currency, what's the tax system, which obviously adds a little bit of complication for an expat. And then if we see how this looks, so if I do a new share, you can see that this is the software that we will go through. So again, we've got this pre-retirement along the bottom, we've got retirement, and we've got slowdown. So these are the people that we looked at, Aaron and Sophia. They're called Demo. And then the kids, Emily and Daniel. This is their income. So we've got this set at 150K. They've got some rental income, which we'll come on to in a minute, and then you've got savings, and you've got some investments. So they've got some cash, they've got some investments, and then they've got this property which is rented out, but it's got a mortgage on it. The expenses we've kept quite high level, as I said, just annual expenses, and then plus university in the future. So it's not going into too much detail. I just wanted to show you some of the things that we will do, and some of the implications for this particular couple. So if we come back to this graph, you can see that every blue bar is an income level for the year. So 38 all the way up to 65. The black line across the middle is their expenses. So you can see when they get to sort of 55, their expenses have jumped up because of some of the university planning, or the fact that the kids have to go to university and they're paying for it. The line is very linear, and in real life, that line is not as linear as that. And neither is the income levels, because it will jump around. It may even be a bit flatter. But it comes back to those assumptions that we need to make sure that it works in real life. When we come into retirement, you can see that there's some red there, and that red is really the shortfall. So they've got a bit of a shortfall, which is obviously a problem, because their expenses are going to be higher than their income. Now, we've set their expenses at that level because that's really what they've told us. So there are some planning procedures that you can do. You can spend less, for instance. You can invest some money. So if we look at some of these insights, how much can they spend at the moment? Okay, so keep an eye on this figure. Okay, so the current capacity for spending is 28,000 per year. Of all of their assets between them, that's what we'll do, and we'll come back to this number at the end after we've done some sort of quite easy different planning tools, or some things we put in place. So keep an eye on that number. Some of the other things to think about is the life needs. So if Aaron or Sophia weren't there, then there's going to be a planning need. So we need to make sure that there's a problem that if Aaron or Sophia weren't there, then Aaron's need would be about $1 million, and Sophia's need would be, actually, it's 100 million. Sophia's need would be 600,000. If they wanted to get rid of that red line here, okay, how much would they need to do every month to do it, or put away? Well, they just need to do 8,700. And this is in sterling, but it could be in any currency. You always got to rebase yourself back into the currency. So if you've got assets in different countries and jurisdictions, they're likely to have different currencies on there. So it's always got to come back to the one that you think in, and then you can do the planning from there. The added implication is that's obviously going to change in the future as currency moves, as well as the return will move as well. Let's look at investment returns. So if you wanted to get rid of that red, the required rate of return would be 9.01%, which is very high. I mean, if you looked back at the S&P 500 back into the 1920s, generally it will do about 7.9% every year. So you've got to outperform the world's stock markets by a couple of percent. So you're taking quite a bit of risk there, which is probably a bit too much for the couple. It really comes down to whether their capacity for that loss can take it. What would be the implications if they try to get that return, which we can obviously model as well. So these are some of the things that they need to think about. So they've got a return that they need to get. They've got an amount they need to do every year in order to make sure that they've got no shortfall in retirement, and they've got an amount that they know that they can spend, that 28,000. Okay, so what did we do for them? So if we come back to screen. Let me do this again. Okay, go back through these assumptions. Okay, so what did we do? First of all, we looked at that human capital. So remember there was that estimation that how much Aaron and Sophia would need in order to cover the family should there be an early death. So we looked at that amount. That was put into trust. So they wouldn't be susceptible to UK inheritance tax because they were Brits. We looked at the modelling, and you can see that if they paid an extra £200 off their mortgage, then they would save some interest, and their mortgage would be paid out earlier. So planning just paying off that mortgage every month, an extra amount, made a big difference to whether or not they were a little bit debt free. And it really depends to whether or not Aaron and Sophia wanted to do that. Sometimes people want to be able to have a mortgage free house. Sometimes they're not too concerned about it. And they'd rather build more properties as a result from it. It really is down to the individual about what that is and whether or not that will work for them or not. But you can see that if we do a quick graph, you can see how much, just with an extra overpayment, that mortgage debt has decreased. We took the couple's disposable amount, so you know they had quite a bit of cash every month. Obviously, make sure that they've got 3 months worth of joint expenses, and it was going into an investment platform in Singapore, just into low-cost index funds. The platform's got no penalties, got no lock-in period, it's not insurance-based. If they change their expat status, then we can put into that repatriation plan, i.e. they can take the assets out and fund their local pension or the local tax bracket. So that's important for that repatriation. If they have to change their job or they need to leave the country very quickly, then they know that they don't have to fund a contractual savings plan. And the implications of them stopping will be pretty big on that, on the accumulated cash they've got into it. And then also what we did was we made them do voluntary contributions for their state pension. So we make sure that they're topped up every year and they're buying years, and that's a whole different webinar. But if you like more information on that, then by all means we can help you with it. So if we go back and see what does that mean, then adding in the overpay on the mortgage, and what we'll do is we'll compare it to the previous plan. And what you want to see is the debt. So as you can see, they've repaid that debt a couple of years earlier. So when they're into their sort of early 50s, they've got a mortgage-free house. So if they're feeling that they want to be able to achieve that goal at the end of their time as an expat, that they've gone home, they've supercharged their finances, and they've also got a mortgage-free house, then that's quite an easy way of looking at it. If we look at what happens if we added in that, putting that regular money away every month, you can see that that red has now disappeared. So let's just compare it to the master plan, although the original one. And you can see that the red's now gone just because they put some cash away every month. And obviously they can change it as much as they can. There's been another increase in this line. So we've gone from a blue line to a red line, a blue line to a black line. And the blue line is their basic needs. And the red line, the black line is now their needs. So that's the amount of money they're putting away. So it's gone up extra, their expenses. They've still got quite a big disposable income, but we've used that in order to remove the red. If we look at the final plan, so we've done both and we've added in the pension, obviously the red's gone completely, But if we start looking at those insights again, and the main one being the retirement spending, remember it was 28,000, right? So now their spending capacity in retirement's gone up to 49. So just by adding in that state pension, making those contributions into a plan, they've increased the amount that they've now got into retirement. And this is quite basic level. If they were to do more because they've got much more disposable income, then obviously that would go up. So a couple of little tweaks, they're mortgage free and they've got more retirement spending, and they're completely flexible in what they can do. So just by a couple of examples, that's how we've managed to help these people out. If you want more information, then by all means, there is all of the ways to contact us, and by all means, drop us an email, get in touch by the usual ways, and we'll be able to take you through an example for you, or actually build a plan for you based on your own individual circumstances. So thank you very much, and hopefully we'll speak to you soon.